All right. Good evening to all the attendees. I think it's the time to start our webinar sharing today. I see quite lots of attendees already starting to join our go-to webinar sessions. So basically, our webinar sharing today will be a crude oil product. So before we really kickstart the sharing today by our speaker, Mr. David Low, so let me have a short introduction to our company. So before I proceed, I would like to have a small disclaimer here. Whatever sharing today by Mr. David Low is only for the sharing and education purpose and not constitute for buying or selling recommendations. And if you want to make your trading or investment decisions, you can consult your remisier, your dealer, or you can take this today's sharing as a reference for analyze before you make any trading decisions. And for our company, Phillip Capital is a company incorporated on 7th of October 1995. Phillip Capital is one of the trading participants of Bursa Malaysia Derivative Berhad, one and also participating organizations of Bursa Malaysia Securities Berhad. Besides that, Phillip Capital also one of the holder of Capital Market Service License. And in Malaysia, we have our HQ, which located in Kuala Lumpur, and across East and West Malaysia, we have total 11 Phillip Investor Center. So if you're interested to enjoy our service, want to consult our financial market news, want to open account, want to enjoy our platform, you can welcome to visit your nearest branch to consult with our staff. So here is some awards winning throughout the years, and the latest one will be second runner up for the best overall derivative trading participant from Phillip Capital, and the first runner up of best retail derivative trading participant, which is 2023. And for our global network, we not only operating and serving clients in Malaysia and Singapore, but also in some overseas countries, for example, France, Turkey, Dubai, India, China, Japan, and others. So it means that we are serving an international client base. For the global coverage, the brokeraging service we provided, we not only provide local access to our client, which is Bursa Malaysia BMD, but also IGX, JPX, and Tokyo from Japan, HKEX from Hong Kong, and the four major exchanges from US, which is CME Group, CBOT, COMEX, and NYMEX, as well as we also have ICE and Eurex coverage for our client. And here is why we can become your one-stop solutions for your trading. I believe that most of you know that Phillip Capital is majoring for the futures brokeraging service, but also we providing the stocks brokeraging as well as a CFD for our client. In futures, we providing index futures, for example, our local, which is FKI, Hong Kong Hang Seng Index, SGX A50, also as US major index, Dow Jones, Nasdaq, and S&P. Besides that, we're also providing agricultural futures, metal, energy, and interest rate futures. And for stocks, we providing local and foreign access to our client, which is Malaysia. For the foreign, we have Singapore, US, Hong Kong, and Australia. And the CFD is for those investor or trader who seek to have a greater leveraging effect or greater risk and return exposure in the equities market. CFD is a better solutions or the better choice for you. So if you're interested, you can consult our company for this CFD product. And why we can become your broker of choice. And as I mentioned before, we are award-winning multi-asset broker. We also having a 24-hour broking and execution support. So in case you are trading foreign market, you are not to worry. You have lack of assistance in the midnight session because our dealer in the headquarters is always there to support and guide you. And for our service, extra service we provide is also advisory service, latest market news, and a wide array of products. Same as I said before, is our futures, equity, and CFD. And now we also having online account opening, so everything can be done online. You don't need physically come to our branch to do this all these documents and things, so it will be more convenient and easier for you. And here is some additional service that provided by Philip Capital. For the first is a free one-to-one coaching sessions, free seminar and webinars, and a free account opening. For free one-to-one coaching session, in case you want to know more about futures, what is CFD, or even the stocks trading, you can consult us. Also, if you want to know more about the product knowledge, want to get up to date to the market news, the later market trend, and as well as a platform coaching and charting system. So if you're interested, you can make an appointment with us so we can arrange our staff or dealer to guide you. And for the upcoming seminars and webinars, we constantly are doing free webinar and seminar to our attendees and our clients, which is exactly what we did on today. So on the screen there is a QR code. If you're interested, you can take the photo or scan this QR code to register for yourself for our upcoming events, and you can check for the schedule which topic we are interested in. And besides that, we also having a weekly market call, which is for the first is a market views and updates, which are on every Monday 11 a.m. So our analysts will present on weekly views and updates, as well as talk about a newly published report and the latest market news. And the another one will be a live counter technical analysis. It will be more suitable for those technical investors who want to trade or invest based on the technical charting, technical analysis. We will be having these sessions every Monday, 8 p.m. So it helps you to discover weekly trends and potential entry and exit level by using the technical analysis and technical indicator. So here I would like to introduce for our online account opening. Here's the QR code for you to scan. We as a one-stop solutions for your or broker for you, we also provide the platform for you to trade in the stocks, futures, and CFD. And here's the QR code. If you're interested, you can scan or take a picture of it. And let's move on to our trading platform. For the first, we have a separate platform for our each of product, the futures, the securities, and the CFD. The first one with the Philip Nova, which is the platform to our futures product. It actually is a user-friendly platform. It's offer over 90 technical indicators for your trading. So there's a buy and sell directly from the chart. You can easily find the button. And yeah, we also provide live market news and price alert in this Philip Nova. So we also provide a demo account for this. If you haven't not yet is our client yet, you can try out for our demo. And if you're interested, you can scan this code. And this is some enhancement and improvement for our Philip Nova platform. Currently, we already launched the newly Philip Nova, which is Philip Nova 2.0. The major enhancement from the previous version is we link the chart with the trading view. We know that trading view, you need to get a subscription in trading view to get the live market price feed. So in case you already subscribe to the TradingView plan, you're able to link your Philip Nova account in the TradingView website and easily access to the TradingView charting system. And the next will be Poems Global 2.0 is actually a platform for our securities trading and investment. Similar with the Philip Nova I introduced just now, it also provide you to invest in both local and foreign market. The major the major selling point of this platform is you easily can find several fundamental analysis tools. So for example, EPS, the PE ratio, you can easily access to the company annual report. So this might be quite helpful for those fundamental investors who want to know company business before make any investment decisions. And we have Philip CFD Trader for our CFD platform. It is a user-friendly interface, and we also provide a live charting for both local and foreign market. So in this platform, you're also able to set a price alert and advance of the type for your trading. And after I introduce our platform, let's move on to the promotion. Currently, we also running some promotion campaign. The first one is a trade CME micro futures. It actually is the promotion applicable for the CME micro contract, which starting from the 1st of May until the end of this month, which is 31st of July. So in this promotion campaign, we basically have the two categories for non-client sites and our existing client side. If you are not yet our client but interested with this promotion campaign, you can sign up this promotion campaign and trade with the minimum lots, so you can entitle 88 ringgit of the touch and go reload pin. And for our existing client, we can base on your trading volume and stand a chance to win up 1,500 touch and go reload pin based on your trading volume. And here's a QR code for this promotion campaign. You can scan for more info and details interested. And the another one is a trade US index CFD at just $2. So for the just now CME micro contract is the promotion campaign for the futures, and this is a promotion campaign for our CFD. So basically, it just offerings lower cost for you in trading US index CFD. So this is a QR code for you to know more about the promotion campaign. So let's move on to our speaker today, which is Mr. Devilo. Mr. Devilo is the managing director of Top Infinity Sendirian Berhad, a proprietary trading firm that specializing in trading global commodities, currency, equity index, and financial derivative market. Mr. David has over 25 years of experience in the listed derivatives industry and has held leadership positions in futures broking divisions of major investment bank in Malaysia. Mr. David was the past president of the Malaysia Futures Broker Association from 2018 to 2019. So basically, today's webinar session will be covering the crude oil topic. So without further ado, let's invite Mr. David for the sharing sessions. Thank you.
Thank you, Jen Chong, for that fantastic introduction, and good evening to everyone as we go in to share this topic and answer the question and explore the topic of whether the oil prices can go up to $100 per barrel. Okay, this is very interesting because over the last couple of weeks, you've seen the oil prices going up. We will see what happened. Okay, we will see what are the factors that cause it to go up, and what's going to happen in the short next couple of weeks or next couple of months. Okay, so before that, just let me share my screen. Okay, I'll just get Jen Chong to give me the permission to share the screen first. Just hold on a second. Okay, it's gonna come up in a while. Okay, let me just quickly go to this. Okay, I hope you're seeing it. Okay, is this looking good for you? Okay. All right. So this is the title: Can crude oil climb to $100 again? And what is the outlook? What is the opportunities in the second half of 2024? Right. So let's have a look at it. Okay. So this is a disclaimer. I didn't. Channel has already showed that, so we shall not delve too long in this. Okay, that's me. Hello. Okay, so this is what we're going to share this evening. Okay, from the main title, we want to gain some insights on the what are the underlying forces currently driving the crude oil prices, right? And how to position yourself for the next big trend in the crude oil market. Okay, so is it going to go? Is it going to continue to climb, or is it going to go down? Okay, so this is the question that we want to answer tonight. Okay, and of course, after identifying where is the next big trend, and how do you take advantage? How do you capture the opportunities in crude oil trends? And we'll look at some of the contracts that CME has, and how to use those contracts to take advantages of the price movements. Okay, before we jump into the exact dynamics of where the oil market is going, okay, let's look at a general idea of where, in terms of all types of asset classes, all types of futures contracts, where are they year to date in terms of performance, right? And you can see right there where highlighted in little yellow box, okay, what you can notice and observe over there that crude oil, equities, especially the Nasdaq 100, the S&P 500, and also the Nikkei 225, one of the top performing Asian indices, and all, including gold and silver, has outshined the rest of the asset classes, right? So all these asset classes have had the double-digit gains. Right, you can see right over here, and of course you have some outliers here. You have cocoa and you have orange juice that has been doing very, very well in terms of their price increase, and that's basically because of the weather and also some of the disease that have plagued these two crops over the last 1 year, right? So it has been because of the shortages of prices of cocoa and orange juice have shot up. Okay, so those of you who buy oranges to eat, also you'll see, hey, oranges in the supermarkets are also very expensive because there is a short supply, in fact, of orange juice. Okay, and that's also impacted coffee, right? You may not have felt that your coffee price gone up, but I think generally coffee prices have gone up as well. And one of the reasons why is coffee as a commodity has actually increased in prices. Okay, but in terms of the investable assets that we're talking about, energy, equities, and precious metals have been the leading performance for this year. Right, so right at the bottom, of course, you still have the soft commodities, the agricultural commodities, still on the downside, still haven't really gone to break even for this year. They're still negative, so we'll have to watch these commodities. Maybe there's an opportunity here, right, for those that have not risen very strongly yet. So it's also good to have a look at those agricultural commodities and watch their prices and their price action to see whether those are a good way to get in at a good price. All right. So this is the what do you call that? The snapshot of all the tradable futures contracts and asset classes in one page. So the question is, who will win the neck to neck race, right? They are all neck to neck, right? 18%, 25%, 11%. So all very close to each other. So next we'll just have a look at this very important chart. Okay, this is a chart of the S&P Goldman Sachs Commodity Index futures, and this particular index has the basket of all types of commodities inside, and a large part of the component of this GSCI index is actually energy products, right? So if you can see from this chart, if there's any bullish kind of signals, it also will signal that the energy or crude oil or natural gas, all these related products are also going to pick up, right? So at this current moment, this is a long-term chart. This is a monthly chart of the GSCI commodity index. And you can see right over here, okay, where my pointer is. This is in March of 2022, right? When the market peaked from the run up in the pandemic. Okay, the pandemic saw a huge rise in terms of commodity prices. Okay, so the whole basket of commodities and the prices actually rose significantly and hit a high in the GSCI index of 845. Okay, and it was just shot by some 40 over points to the all-time high in terms of this index. And this all-time high of 88850 is actually the high of the previous commodity super cycle. So that is why during this time period in mid 2020 and running into 2021, and especially in mid 2021 to the beginning of 2022, all the analysts and all the commentators on the commodity markets were saying that, hey, this could be another commodity super cycle. Of course, after what do you call that, the first quarter of 2022, I mean, prices started to fall steeply, and this was because of concerns of the global economy and especially China. China was one, and probably is still today, one of the largest consumer of global commodities. And if China's economy were to be weak, okay, and later we'll see whether the data are showing that as well, and the fears of the China going into difficult times in terms of economy saw commodity prices drop drastically, actually, right? But actually, if you look at this, if you are a seasoned in technical analysis, you will see this what we call a bullish flag. Okay, so what is a bullish flag? A bullish flag means that this particular formation or this particular chart pattern, okay, signifies that it's a continuation pattern. Okay, what does it mean? It means that the trend will continue after it finishes the formation in the same direction of where it started, right? So it started right over here, and this is what we call the technical analyst called the flagpole. Okay, this long thing was a flagpole, which signifies a very significant and rapid surge in prices, and followed by this consolidation here, which forms the flag. All right, so this is a continuation factor, okay, pattern, and if it plays through, okay, and it breaks out convincingly, then you're probably looking at another impulse wave on the upside. Okay, we shall go in and what do you call that? Study this particular chart in a lot more detail afterwards. But I want to point out to you as well, those of you who are technical analysts, that this is what we call a double bottom formation. Okay, so this particular high right here, if you see my cursor, this point here is about it's around 625. This particular point is very, very important point. So if it breaks this particular point, then it will be a breakout of even what we call a double bottom formation. Okay, so you have two types of bullish formations and two types of patterns over here, which is suggesting that the GSCI commodity index has formed a critical bottom, okay, at the 520 level, okay, and with this waving that bullish flag, okay, is saying that I have a chance to come back, right? So let's go in and see later, okay, with a more detailed study of this particular chart to see whether that's true, right? So there's something which may be very exciting, not only for oil but for commodities as a whole, right? So now I want to compare two charts. Okay, so those of you who have been in the equity markets, okay, even Malaysian equity markets have been rather uh, active, right? And we've come up since the last quarter of last year, and including the international indices. This is the US indices on the right, which is the E-mini S&P 500 index, and you could see that from October of last year, elected a bottom and continued to climb until today is still climbing. Okay, and this was a chart that I extracted last night. It's still continuing to make new highs. Okay, so now what about the GSCI? So GSCI, you saw just now that it's trying to find a bottom. Okay, so now you have two charts and also one dilemma. Which one to buy? Okay, should I buy the ones going higher, which is the equity indices, right? Is that a golden chance continue to climb, or do I buy an opportunity which is at the low, okay, which is commodities and energy products? Okay, so this is a good question to ask yourself. Okay, are you someone with the personality that looks for a opportunity to buy at low, okay, or you are a momentum trader that continue to buy on high? Okay, so well, it doesn't have to be a dilemma. Okay, you could do both as well, right? You could buy the S&P as well, or the Nasdaq, and see it continue to rise. Okay, but do note that lately there's been a lot of commentary and analysts to say that perhaps the AI rally has kind of overextended itself. Okay, but we don't know. The prices are still going up. Okay, and we continue to see higher prices every day on the S&P. So that's something that we continue to observe. Okay, and of course for the GSCI we continue to observe to see whether it's able to convincingly come up of the top. All right. So the 620 level we saw just now, which is the double bottom trigger, is right over here. You can see right over here, 620. So that's a very critical point, right? So put this chart, the GSCI, in one of your favorite charts and see whether it breaks the 620 level, which is a crucial level to break for the S&P GSCI commodity index, right? So buy the low or buy the high. Okay, you have to make a choice over here. Okay, so let's now dive into the key fundamental drivers of commodity markets, including energy markets and crude oil. Okay, in one page, you are basically looking at all the major factors that can actually affect those prices in the next 6 months. Okay, so you have, of course, the geopolitical conflict. Okay, of all the factors that's going to hit hard. Okay, in terms of commodity price and what do you call that, and oil prices. Okay, and when I say hit hard, doesn't mean that it's going down. It could mean a very huge surge in the prices of commodities of oil itself, because conflict, geopolitical conflict, especially those currently happening. You've seen news over the last 4 weeks, the Houthis activities in the Red Sea, what do you call that, basically causing a lot of problems in terms of the security of ships passing through the Red Sea. You have the what do you call that, the Israeli and Lebanon and all that having a problem in terms of the tensions. Okay, and of course over the Ukraine as well as the Russian conflict that has not been resolved. Okay, and in fact, hostilities and what you call it has escalated over the last couple of weeks as Ukraine fired missiles into Crimea. So all these what do you call that, points, flash points of tension and geopolitical conflict is going to play out in the sense that be a very big factor in determining the prices of commodities, right? Of course, if the conflict were to escalate and become worse, then in terms of commodity prices and oil, of course, that is in one way very supportive of prices. Prices will rise because of the fear of disruptions in supply, and also whether the supply can come to those that require it. Okay, so this is something that you have to watch very carefully in terms of trading commodities in the next 6 months. Okay, so keep your news really on tap in terms of what's happening in the Middle East, what's happening in Ukraine, Russia, and also okay, God forbid, what's going to happen in the Straits of Taiwan. Okay, so this is something that if it becomes another flashpoint, then the word that people use really these days so commonly, talking about World War III and all that, and all these are just basically playing out that particular scenario of World War III. So this is very important to watch out, right? Now, in it's part of one of the related effects of geopolitical tensions and the rise of commodity prices will be inflation, of course, right? So inflation due to oil prices, inflation due to rising costs of the commodities. This is one thing that is going to cause a big problem. Okay, in some sense, the Fed is trying to control the inflation so that it doesn't run away, right? The U.S. numbers in terms of inflation later, you will see that has been pretty encouraging, right? So as kind of make the decision by the Federal Reserve kind of easier to make in the next 2 months. Okay, but still, going forward, okay, if things like the conflict were to escalate, then what's going to happen to that, right? And it has a tremendous impact on the US dollar as well, right? If interest rates, all the talk about interest rates, cutting interest rates by the Fed, and whether the Fed can aggressively go on a cutting spree, that's something that we need to see. Okay, and all these are interrelated. Okay, although they are separate factors, they are interrelated. Okay, so what about the global economy? What's the outlook of the global economy? Okay, and there any countries, especially if you're watching the US, is the US going to go into a recession? So all these things we'll have a look in the next couple of pages. Okay, but this in one shot, okay, will tell you what you need to look at in the next half of the year. So yes, let's talk about U.S. inflation, right? In terms of the data, the latest data that came in May showed that actually the U.S. inflation unexpectedly slowed to 3.3%. And this is the lowest in terms of the last 3 months. And as you can see from the chart here, this is a chart that dates back to the previous year's May. So it's 3.3, okay, lowest in the last 3 months. But of course, in 2024, it started the year basically at 3.1%, right? So this was good news. And at that time, it really gave encouragement for the Federal Reserve to be able to do their interest rate cuts, right? So a lot of people were talking, wow, at this present current rate of 3.1%, and perhaps looking forward can still continue to go down. The Fed was like, okay, looks like really we can start cutting those rates a bit more aggressively, right? But the numbers are coming in a bit spotty, a bit mixed, okay? So we will have to see the next number. The next number is going to come out tomorrow. Let's see what's the number coming out. There is consensus for the June numbers to come at 3.1%. Just remember that in May it was 3.3%. So if it goes down to 3.1%, then well, this is going to be interesting as well. It'll be the low of the last 5 months. Okay, so let's see whether these numbers come in tomorrow lower. Okay, in terms of unemployment rate, okay, this is a key point that the Federal Reserve looks at in terms of their policy decisions on interest rates. Unemployment rate in June actually went up. Okay, what does that mean? Unemployment rate. That means the less what do you call that? There's more people getting unemployed. Okay, so it rises to 4.1%. Okay, and this figure actually surprised the market. The market was only predicting a 4%, what they call that, unemployment rate, but 4.1%, basically saying that the labor market is cooling off a bit. Okay, and because of this labor market cooling off, then it gives a lot of inspiration, perhaps, if they want to cut rates, and raises the optimism that the U.S. Central Bank can actually engineer a soft landing for the U.S. economy, right? So this is in terms of a figure, okay, it's very encouraging for the Fed to be able to cut rates. Now let's move on to non-farm payrolls. Okay, non-farm payrolls just came out the last week. Just a quick off the start. Last month in May, the non-farm payrolls NFP numbers were very, very hot. Okay, came in really, really unexpected. That in fact they had to go back and readjust all these numbers. Okay, as you can see right in the second data bullet point here. Okay, the May numbers were actually revised sharply lower. Right, initially it was 270,000 K. So basically saying that a lot of jobs were added into the market, and this was kind of funny because the rest of the unemployment numbers were actually going up. That means jobs were cooling off. Okay, there were not so many jobs, but this NFP number came in May and say, wow, there's so much, a lot of jobs, being taken up but so they had to revise it. Right, May was revised, April was revised downward as well. To 108, and in that sense the employment in April and May combined is actually lower than previously report. Okay, but still in terms of the raw non-farm payrolls in June, it came in above the expectations as well, right? Although the actual number is less, right, after adjustment. All right, so this is another number we need to watch. Okay, the Fed definitely watches this in terms of the decisions on their interest rates. Okay, in terms of the US core PCE number, okay, and this number comes out late of this month, 26th of July. And of course, those of you who are familiar, the core PCE is the key and the Fed's favorite inflation gauge, okay? Basically, this is the personal consumption expenditure number, right? And the number in May was 2.6%, okay? And this was the lowest in since March of 2021. So very encouraging in terms of the inflation, the price index coming down, and they are expecting at the end of this month, on the 26th of July, the numbers should come in at 2.6% as well. So let's see whether there are any surprises, okay? Because the Fed really, this is their favorite. They look at this number like a hawk, okay? To determine their direction in terms of the rates, right? But 2.6% is still above the Fed target. Okay, remember the Fed target for inflation is 2%. It's still above. Okay, let's see whether the Fed can really, or the numbers in 26th of July can taper off to 2.6%. So let's see that number in coming in end of the month. Okay, so in terms of the trader consensus for September, there's a very high chance, 73.6%, that the Fed will cut rates. Okay, the current rate is 525 to 550. Right over here, you'll see that in the September meeting, and it's on the 18th of September, right? There's a 73.6% chance of it having a rate cut, right? So keep tab of this. The CME Fed Watch tool is a fantastic tool to watch where the action on the market is showing where traders think the actions of the Federal Reserve across different meetings, right? So you can click on the September meeting and see what is the percentage. You can click at the 7 November meeting and see what is the decision, and you can also see the trend of the probability right at the bottom over here, right? So you can see the 1 month thoughts. Okay, so you can see right over here, a month ago on 7th of June, okay, only 46.6% chance of a rate cut in September. And as it went to 1 week left, it's 64.4%. A day ago is 72.2%. And right when I took this snapshot, it was 73%. So you can see the trend of the consensus of the traders, whether it's really picking up in terms of the certainty of the price cut in September. So it looks like a lot of traders feel that this is going to happen in September. Okay, so let's go in and look at the global economy. What is the prediction? What is the projection? And this is from the report of IMF in terms of the world economy outlook in April of 2024. They released this, what do you call that, report. And well, it's not a really, it's not a bad report, but you can see right over here where my cursor is, the global economy is looking like it's going to be staying at only 3.2% up to 2025. Okay, so only 3.2%. Okay, not that great. Okay, the pace of the growth. Okay, advanced economies have a bit of upside. Okay, in 2023, 1.6, and it's going to go up 1.7 and 1.8 to 2025. But in emerging markets and developing economies, things are not looking that great, right? So 4.3% in 2023 is going to look like it's going to drop to 4.2 in the next 2 years. So this is what the IMF sees in terms of the global economy. There is, of course, global recovery from the pandemic, okay, but still, okay, still the recovery is slow. Okay, and the key themes from this economic outlook is basically this, right? There is divergence in growth. Okay, so the US actually recovered above their pre-pandemic trends. Okay, but right across the globe, the recovery is still very spotty. Okay, there are a lot of other economies that are still struggling to recover, not only from the pandemic but the rising cost of living. Right, you saw the huge spike in the commodity prices mid of 2020 onwards to beginning of 2022. So a lot of countries and a lot around the world are still struggling with this. Right, although the IMF sees the global inflation moderating, okay, the headline inflation is projected to decline from 2.8% end of 2024 to 2.4 end of 2025. So they see inflation moderating. However, in terms of the recovery of the global economy, China is going to continue to weigh, okay, affected by contraction in the property sector, okay, one of the biggest problems facing the Chinese economy, and of course, a very depressed domestic demand. Okay, a lot of people were invested in the property sector in China, and when it took a beating, when prices took a beating, okay, a lot of the citizens in China basically held back in terms of their domestic demand, held back their spending. Okay, and basically this is due to subdued confidence. Right. So, in terms of the IMF, what is the risk ahead for the global economy? One of it is the geo-economic fragmentation. Okay, what's the meaning of this long word? Basically, is the world is breaking apart into its own economic blocks. Okay, so excuse me. Some countries are forming their own blocks, others are forming their own blocks. So it's not the global economy is not so smooth in terms of the cooperation anymore, right? So this creates inefficiencies This creates a lot of damage to global cooperation, and of course, increases costs in terms of global trade, and causes a lot of disruptions in terms of the supply chain, right? So it's one of the key risks in terms of the economic growth going forward. Excuse me for that. So let's move on and look at China, right? So we spoke about China. Are there any nice, good news coming off from China, right? Let's look at some of the data. In terms of the May 2024 export numbers, okay, very encouraging in terms of the exports. So we've seen a 3 month high, okay, from a low actually beginning of the year. The numbers that came month and month after that has been very encouraging, right? So 3 months are high in terms of the export, so this is good, okay. What about the imports, right? Imports are still rather lackluster. You can see, it's already just tapering off, okay. And basically, I think this reflects the lack of confidence and the weak domestic demand, right, in terms of the imports. Okay, but where are the green shoots? Where are the green shoots in terms of the China's economy? Okay, one of the main thing that a lot of people watch, economists watch for China's numbers, are the China manufacturing PMI, okay, which is the producer index, right? So the Caixin China General Manufacturing PMI actually in June came in at 51.8, okay, higher than May's figure, and even beating the market's forecast of 51.2. Now, how this PMI works is this. There is this line here you see, which is the amber line, which is at 50. Anything above 50, that means the PMI or the this particular index is growth. Okay, anything below then is contraction. Okay, so you've seen expansion. Okay, expansion in terms of this particular PMI number, and this is the highest figure since May of 2021. Extremely encouraging. Okay, these are the kind of green shoots that you will need to find in terms of the China numbers to see whether China has actually formed the bottom. Okay, and these are some of the green shoots that you can see, right? It was the eighth straight month of increase in terms of the factory activity, and output hit a 2 year high. Okay, and new orders also rose for the 11th month. Okay, so these are encouraging numbers in terms of productivity, and this is something that you want to follow as well and see whether the numbers continue to stay above 50, right? So China has, of course, done a very drastic move in May, right? Going move to boost its economy by issuing a 1 trillion yuan bond, especially to revive this property sector, right? So this is a very important sector to revive, and if the property sector can come back, then perhaps the consumer confidence can pick up from there. So, but of course, this batch of 1 trillion yuan bonds is a longer term. It's going to be in trenches. Okay, so the effect may not be immediate. Okay, but watch for the data coming up from China over the next couple of months. We'll see whether the effect has kicked in or not. Okay, this is one of the most aggressive moves in terms of the China government in terms of boosting its economy. Right, so we have to see whether the results will come in the next couple of months. All right, what about the US economy? Okay, US economy, well, you see the IMF report to say that it's recovered above the pre-pandemic levels. Now, one thing to look out for is this very interesting phenomena called the US yield curve inversion. Okay, why is this yield curve inversion? And what is, okay, let me describe what it is first, right? A yield curve, a normal yield curve, basically you see the short-term rates to be lower than the long-term rates. Okay, so say a 10-year treasury would have a higher yield compared to a 2 year treasury, right? But then in terms of a yield inversion, what it means is the 2 year treasury yield is now, okay, higher than a 10-year treasury yield. Okay, so your 10 minus 2 is now negative, right? So this is called yield inversion. And yield inversion is a phenomenon that is watched a lot by economists because it is a reliable indicator of when a recession will come in, right? And it's an indicator of recession coming in 14 to 18 months after the inversion. So you can do your own mathematics, okay? So the inversion started in July of 2022. So you count 18 months from there, okay? So if you count 18 months from then, aren't we bit really very close to that already. Okay, so this is an interesting note in terms of the U.S. economy. Okay, although it has recovered from the pandemic levels. Okay, so this is one key thing. And one of our colleagues, our economists in terms of the chief economist in CME, right? He presented this paper in May, and it has a very interesting table right over here. Okay, and of course his conclusions as well. Right. Basically, he's saying that the yield curve, as seen by the data collected here, is often a great indicator of the economy 2 years ahead. Right. So if you have the last rate hike, okay, when was the last rate hike? And when was the yield curve inversion? With these two pieces of data, right, you can kind of predict when whether there's a likelihood of a recession coming, right? So July was where Fed's peak rates, okay, and the yield inversion we saw just now was in 2022 as well, right? So when is that going to come, right? Because all the occasions previously in the recession that happened in February 2020. There was rates that peaked in December 2018, and was there a yield inversion? Yes. And after the yield inversion, 40 months after that, there was a recession. In December 27, okay, the recession also happened. 18 months after this happened, the last rate hike, and also the yield inversion. So it has been shown to be a rather reliable and great indicator of where the economy is heading to, right? And at this current moment, with the yield inversion as well as where rates have peaked, okay, that is basically saying that in 10 to 18 months or up to sometimes 18 months is where you will see the recession starting. Okay, so the key question now is, has a recession started for the US economy, right? With the stock markets at that rate, okay, it's probably a bit unlikely for a lot of investors to think that the recession has started. Okay, but this is data, and this has shown to be consistent over the last four recessions. Okay, so let's move on after that particular interesting piece of data. Okay, let's look at now specifically the crude oil drivers. Okay, so we look at US production. In terms of US oil production, is continuing to rise, and that's one of the reasons why the oil prices have not been able to really push ahead, right? You see the latest number, crude oil has risen to what you call that, 13.2 million barrels per day in the week of June 7, okay, coming from the previous 13.1 million barrels, right? So now, one thing to note is in terms of the US production, the all-time high, okay, in terms of production is the 13.3 million barrels per day, and this happened end of last year, December. So in terms of production of crude oil, okay, US now is producing right at its historical peak. Okay, so US being now actually able to export oil. Okay, and this particular supply going to the global markets is basically what's been keeping oil prices in check. Okay, so despite some of the geopolitical conflict that's happening and escalation, okay, oil prices have kind of stayed rather steady due to the supply that the US is bringing into the global market. Okay, so let's look at some other numbers as well. Okay, but one is interesting is over the week, the previous week, in terms of the inventories in the US stocks. Okay, US oil saw a large drop of 12.16%. Sorry, 12.16 million barrels. Okay, the last data that came in. It's a sharp draw in the inventories. Okay, this is the stocks of the US crude oil. Right, it has a sharp draw, and this is one of the highest draw in terms of the year 2024. Okay, so that means, is it indicating that's demand? Okay, but that's very possible as well, because during this particular period, okay, people were looking at going for this is a typical busy driving season for the US because of the Independence Day and the holidays. So a lot of cars are on the road. So perhaps an expected drawdown on the inventories because of the demand of this particular holiday. Okay, so that's one of the reasons as well in terms of the draw. Right, so let's continue to look at the trend of the draw. Okay, and this numbers comes out every Wednesday, so look out for it as a Malaysian time 10:30. The numbers will be released. Okay, so there is a schedule of release of these numbers for the US crude oil stocks. Right, this is an important number to keep tab on. Right now, in terms of supply and demand, what about the oil rig count? Okay, oil rig count is how many oil rigs are active. Okay, and they count it. And this Baker Hughes is the one that provides the numbers on the crude oil numbers of the crude oil rigs. Okay, and in terms of the latest figure that came in, it remained unchanged at 479. However, 479 is not a very good number in terms. It's the lowest reading since December 2021. Okay, and it's very interesting to see that the U.S. oil rigs have been actually going down. No, it's actually struggled, and the highest was the peak was actually 627 number of oil rigs in December of 2022. Okay, but you might be saying, hey, how does this happen? How does U.S. crude oil rigs continue to go down? Because this is where you drill for oil, right? It's going down, and yet U.S. at historical high production oil production. Okay, so this one of the reasons why is because of the technological advances and efficiency gains. Okay, technology. Okay, so despite a 69% decrease in the numbers of active rigs since 2014, U.S. crude oil has what you call that able to now actually pump near its historical high. But the question remains, okay, if the rigs are continued going to go down, okay, there's only a certain maximum amount of efficiency you can draw from in terms of technology. Okay, so perhaps with this kind of figures coming in, okay, you might see the US production, although remain high, will taper off around this current levels. Okay, so this is something that we need to watch. Okay, because there's no new oil rigs coming in and drilling, right? So you're only relying on efficiency, right? So efficiency has its limits, right? You can only achieve peak efficiency up to a certain number. After that, then you're already pumping all out already, right? So we have to see these numbers going forward in the next half year or next 1 year. All right. So in terms of OPEC, okay, this is a very important player in the oil market, right? OPEC, they are able to make policies among kind of their cartel. Okay, they have all the members of the oil producing countries, and then they can basically dictate in terms of the supply to the market, right? So 9 of the members actually exceeded. Okay, they boosted their crude oil output by 100,000 barrels a day in May. All right, according to a survey, and this is basically the members not complying to the quotas that they were set. Okay, and this is a rather interesting challenge for OPEC Plus and its members to comply to those quotas. Okay, and also in June of second meeting, the OPEC actually agreed to prolong the output cuts of 1.65 million barrels per day to end of 25. They're going to do that until end of 25, which was signaling to the market that demand is weak. Basically, that's why oil prices came down quite drastically in that week when they had the OPEC meeting on the second. Yeah, basically, although it managed to bottom out, but the feeling at the time was, hey, these numbers are saying that OPEC itself doesn't have confidence in terms of the demand, right? But one thing to note is due to the oil coming up from the US supplying the global market, the OPEC influence, okay, on the price, oil price, global oil price is somewhat waning a bit. Okay, not so influential as when the time that the US production was down during the pandemic period. OPEC had a big impact in terms of oil prices and during the policy meetings, right? But now with US oil coming to the market, the OPEC Plus call in terms of the pricing of the global oil has somewhat weakened. Okay, so this is something to note in terms of the OPEC. All right, China oil demand. This is very important again. Okay, the International Energy Agency basically sees that China demand is slumping, right? So it's not really looking that good. Okay, demand growth as far as the latest numbers coming out April, May has gone down. Okay, quite drastically, right? So they also tracking the China refinery, because these are the people that actually process the crude oil, right? They also see that it's slumped 8.7% year-on-year basis. Okay, so this is a sign that in terms of the crude oil imports, also quite subdued due to this. The runs are not doing well. Okay, so world oil demand growth, according to the IEA, continues to slow. Right, in 2024, only sees 960,000 barrels a day increase, right? So this is actually below the last month's forecast. So at this current moment, the oil demand doesn't look that great. Okay, coming from the latest numbers, we will have to see the new report coming up this July very soon, right, to see what is the numbers. So oil demand for China and both global, this doesn't look that great at this current moment, right? So now we've looked at the key fundamental drives. Let's go in and look at the technicals and see what the technical says in terms of the opportunities for us, right? So let's look at this weekly chart. Okay, this is a weekly chart of crude oil, WTI, and of course, weekly chart looks at trends over the next 6 months. Okay, now what we see currently is this is analyzed in what we call the Elliott wave. Okay, so in this Elliott wave analysis, okay, there is this five wave bullish impulse wave that's still currently at the fourth stage. So the fourth wave is actually a consolidation wave, and this is has turned out to be quite a complex consolidation. You can see right over here, right? It did try to make a move, okay, in end of last year, October, right, above 90 over dollars per barrel, okay, but then come off back again, back to the consolidation support level at about 65 to 70, right? So right now what it's basically doing is it's trying to complete its wave 4. It probably has convincingly made a bottom right here at 64. Okay, now it needs to gain strength to form this wave 5. Wave 5 is projected to be a strong wave upwards, okay, and this wave is supposed to take off the high at 130 of this wave 3. Okay, so let's see whether that plays out. So after a very long consolidation, okay, this long consolidation, if it breaks out, then this next trend will likely to be very strong, and this particular strong move upwards will be the wave 5, according to the Elliott wave. Right, so it's currently looks like completed wave 4, now looking at a consolidation, forming a base for the next upward surge. What about the daily chart? Okay, daily chart are showing similar signs as well. For those of you who are familiar with charting chart patterns, you will see right here that this is what we call a, triangular formation. Okay, so you see right over here, comes up, touches here, goes up to that triangle, touches down, and go up to this triangle. Now this was the move in the last since beginning of June. Okay, after it bottomed out at in somewhere in June 2nd, when the OPEC came up with the numbers, then it strike up upwards. Okay, because of a lot of factors as well that affected it. Of course, the Middle East tensions, the Middle East conflict, okay, had a big part to play in it. Okay, but also coming into the July 4th holiday, the Independence Day, and of course, the last week there was this thing about the barrel, the Hurricane Barrel. Okay, luckily, unfortunately, it didn't cause much damage, and it's already passed. It's turned into a tropical storm now, so Beryl is no longer a factor, and that's why, since it was no longer a factor, the traders actually then took a lot of profits. That prices went up to about 84 half, down now to about 81 US dollars per barrel. Okay, it is still in a consolidation. Okay, it's still in what we call a triangular consolidation. In order for it to move up, it needs to break out of this triangle convincingly, right? So it is expected to perhaps break out on the upside, but we'll have to see. Okay, this is currently in a consolidation. All right, what about the dollar? Okay, dollar traditionally have been a large impact on crude oil prices as well, right? What was the traditional relationship was there was an inverse relationship between oil prices and dollar. If dollar were very strong, then of course the US dollar price oil is going to be very expensive, okay, and that means that perhaps demand will fall because of such being so expensive, okay. So dollar is a key right over here, right? In terms of this chart, basically saying that it's done a corrective wave four, okay, a possibility of dollar rising into a fifth wave, okay. But one of the things that is very different now, as we spoke just now about the US oil going into the global supply. Now, if the US oil goes in the global supply and you buy the US oil, right, you're buying dollars as well, right? So if there's a huge demand for the US oil, then both, okay, both US dollar and also the WTI will also go up. Okay, so this relationship of the inverse between the oil price and the dollar is kind of getting to be very strange these days. Okay, so it's gone into positive correlation. Okay, and most of the time previously it was a negative because inverse, right? Inverse relationship, but now it is in positive correlation, which means that it is going the same direction. And one of the main reasons is because of US oil being sold in the international markets. Okay, you buy US oil, you're also buying the dollar in terms of the you have to convert to dollar to buy the US oil, right? So that's one of the reasons why this correlation has gone positive in terms of dollar versus the oil price. Okay, this is something to note. Okay, GSCI, a bit more analysis. Okay, just now we saw that bullish flag, we saw the double bottom. Now we look at the Elliott wave formation. Okay, it is also showing, okay, a possibility. It's gone to the wave 4 zone. This pink zone is the ideal zone for wave 4 to find its bottom, and it has landed nicely over here. So again, it needs to take off the 620 level, which you saw is now very, very critical. If it takes off the 620 level in terms of this, then we will see positively that this wave 5 is going to come as well, right? So it's very interesting to see all those commodities, oil prices, okay, looking at a possibility of a wave 5. And a wave 5 is a wave that needs to take out, or is expected to take out the wave 3 high, right? The previous high is going to be taken out. So this is very interesting phenomenon and very interesting projection. Okay, so how do you take advantage of all these trends that you see over the last couple of charts, right? So whether you're going to take action and try to buy a bottom right over here, right, or trade the range, on a short-term basis, how do you express this view, right? So let's go in and look at some of the contracts from CME that can do that. Okay, there are two main contracts for trading the WTI crude oil. The first one is, of course, the big granddaddy of crude oil prices. This contract is called CL. Okay, CL is the WTI crude oil futures, okay, otherwise known as the West Texas Intermediate or Light Sweet Crude Oil. Okay, why is it light and sweet? Is it really sweet? Okay, actually it's sweet. Okay, I've not tasted it before, but those oil guys, when they taste it, actually sweet. Very, very interesting, right? So WTI is a light sweet crude oil, okay, from stored and distributed in Cushing of Oklahoma. This particular contract is the global benchmark for US oil prices, right? And it's one of the heavily traded products commercially. A lot of them use it to hedge against any oil price adverse moves. Okay, a lot of hedges going, and of course, a lot of people going to take risks and speculate on the price of the oil as well, right? So this contract is traded almost 24 hours. Okay, and daily it trades close to 854,000 contracts. So it's a very, very active contract internationally. Okay, and the size of this contract is 1,000 barrels. So every time you buy one contract of WTI, the CL, you're buying 1,000 barrels of oil, right? And the minimum tick is 1 cent, right? So because it's a 1,000 barrel contract, every 1 cent move is 10 US dollars. So this is a big contract. I used to trade this contract as well as my favorite contract besides gold. Okay, so I like gold and I like crude oil, black gold. Okay, two of my favorite contracts. Okay, and it's a very, very good. Some of you who can't spend time trading in the daytime because you have a business or you have a day job, right? Have a look at the WTI. This is a great contract to trade, especially the smaller contract. Let me show you this. This is the micro WTI, right? So this is a tenth of the size in terms of compared to the CL, the big brother. This is a big brother, 1,000, and this is a younger and also a smaller brother of 100 barrels. So those of you who this is relatively cheaper in terms of margin to trade. Okay, the startup capital to trade this is 1/10 of that of CL, right? But and the liquidity is still very, very good. It trades over almost 100,000 contracts daily basis, right? Of course, if you trade this contract, you have more flexibility to do position sizing because of the smaller size. Okay, so this one good contract to start out. Okay, and because it's 100 barrel, the minimum tick is still 1 cent. So instead of 10, it's now $1 because it's 1/10 of the CL. Okay, fantastic contract to express your view on crude oil. Okay, so now where are we? Okay, I'm gonna go and share my live chart setups. And meanwhile, okay, while I share this, you can put in your questions into the chat group, and later uh, Chen Chong will join me to answer your questions. Okay, so I'm gonna go in and share my screen and look at the what do you call that uh, my browser. Okay, let's hold on and let me share my browser. Okay, share. Stop sharing first. Then let me share my browser. Share screen. Okay, just hold on a second while I get this up. Okay, I hope you're seeing a chart right here. Okay, so this is a weekly chart of crude oil. Okay, sorry about that.
Sorry, Mr. David, we're not seeing your
Yeah.
charts.
Okay, not seeing. Okay, give me a moment. Right, where is this? Okay, if I share. Okay, share. Okay, are you seeing it now?
Yes, all good.
Okay, fantastic. Okay, so this is a weekly chart. We've seen this just now, so it's in sideways consolidation. Let's look at the hourly chart and see where this is going. Okay, so this is a shorter term. Yeah, so you see that the after hitting a high of about 80, this level is about okay, 84.5. Okay, so it's come down over the last couple of days, right? It hit the high on Friday last week, and then this week has been all the way down, right? So in terms of the current trend, okay, in the next couple of days, the trend still looks like down. Okay, trying to look for supports around the 80 and a half, 80 levels, right? So this will be kind of a deep $4 drop, okay, from the high of 84.5. Okay, so in terms of the shorter term, current trend is still on the downside, right? Daily trend can see right over here. Let me reset the chart. Okay, yeah, it's basically still coming off. Okay, so I expect some correction still, perhaps 50% of the move from 72 to 84, which is a $6 move. So it's highly possible to see coming down around this support level. You see this support level where it's been trading at the range, okay, right over here as well. So the 77 to 78 level is a critical point for it to find some support. Okay, so this is the current view in terms of the live charts. Okay, so yeah, we're gonna get back to our MC Jen Hong and see what questions do we have from the floor. Back to you. Let me stop my share. Okay, so back to the MC.
Okay, thanks, Minister David, for the sharing. So hopefully the sharings on tonight regarding on the crude oil market are the potential opportunity, the potential movement of the coming markets will be benefits for you. You can use it as a reference of a tool to analyze the for the coming market before you do any trading or investment. So for now, Mr. David, can you pass me back as the presenter?
Okay, Ken, let me stop sharing. All right, stop sharing. Okay, it's that back to you.
Okay, 1 minute.
Mm.
Okay, now we open up for our Q&A sessions. If you after enjoy the sharing session from Mr. David, if you have any inquiries or question, you can drop your question in the chat box. So Mr. David will be answering your questions. So before the attendees drop the question, actually I prepared one questions for Mr. David. How you
Ah, cool.
Okay, how you see the U.S. president elections will affect the movement of the crude oil in the end of this year?
A great question, actually, right? In the last quarter, or even the run up, the second quarter, this 3 months running up to the U.S. elections, okay, currently there's still a lot of uncertainties, right? So a lot now is a question of whether Biden will continue to be the candidate for the Democrats, right? It's very important because according to one expert that actually predict the results of the U.S. elections, and he has like predicted almost 90% correct in terms of who is the next president based on some criteria. The criteria of incumbency, which is what Biden has now, he's an incumbent president, is a very important factor. Now, if the Democrats were to lose the incumbency, okay, in terms of the factor, then there's a very high chance that the other party, the challenging party, which is Trump, okay, currently it's assumed that Trump will be the candidate for the Republican side. It's going to have a rather bigger odds of catching that presidency, right? So, you've seen comments from the President Biden that he wants to stay on, okay, but there's been a lot of talk behind about replacing, finding another candidate in terms of for Democrats because of the results, or the results that they didn't like from the presidential debate happened 1.5 weeks ago. So this remains to be seen. Okay, but in terms of looking what is ahead in terms of who wins the election, okay, moving up towards the run up to the election, normally what happens is there's a lot of uncertainty. So when there's a lot of uncertainty, people will look to put their money into safe haven assets. Okay, so gold is likely to benefit from safe haven flight of capital, and of course also the US dollar. Okay, don't forget that the US dollar is also a safe haven in terms of what currency to hold, or what asset, what currency denomination of the assets that you hold, right? So if you buy US stocks, obviously you are buying US dollar as well. So the US dollar tend to strengthen run up towards to the election date. Okay, so that's one of the reasons. Now, the other thing to look at is the policies of each of the presidents. Okay, so the Biden administration is more into green technology, renewables. Okay, not so favorable to crude oil and fossil fuels. Right, whereas on the opposite side, Trump is very friendly to the oil majors. He's very friendly to the oil people, right? He himself likes oil somehow, right? So his policies are beneficial for oil. So in terms of that, look at the differing policies, okay, of the various presidents, various administration in terms of looking at the energy. Okay, one is green energy, renewable energy. One is friendly towards fossil prices. Okay, so whoever wins, okay, again I say the question of incumbency, right? If Biden does not become the candidate, then Trump has a high chance of win, and he's going to be friendly for oil. All right. So I hope that answers the question for you, Jinchong.
Okay, thanks, Mr. David. He's actually answering well the question. So, one last question for you. Actually, for your opinion, what's the major factor for you to consider to before, or the potential downside risk before trading in the crude oil in coming quarters?
Hmm. As you can see from the all the charts we see, there is a bias towards the upside. Okay, because the current phase of the market is in wave four. Okay, so wave four you see consolidation, and that's a possibility. Okay, the risk is if prices now break across the low. Okay, so like crude oil 64 is a very important point, right? If prices trade below 64, then all bets are off, because that is the predicted or the projected wave four low, right? So if it breaks that particular low, then perhaps then it's I think the whole picture will change. So now the 64 US dollar per barrel is a key point to remember for tonight. Okay, if it breaks that all the projections, all bets are off, right? Because that is supposed to be the way for low. Now, if that holds and then you see prices break out and you see the Goldman Sachs Commodity Index break through the 620, then that's going to be very, very positive that the wave 5 is on the way. Okay, so in terms of risk wise, okay, look for that 64. It shouldn't touch 64. Just now we saw some of the charts. It should consolidate around that triangular thing, right? It's going to get smaller and smaller and come to a point, right? And the highs and the lows are going to get higher, right? And the next breakout, okay, is expected to be a upside breakout. So it's very important. A downside breakout is technically on the charts is not expected, but if this happen, then all bets are off on the trend. Okay, but as it is, the bias is on the upside for crude oil. Back to you.
Okay, thank you, Mr. David. So I think so far due to time constraint, I think that's all. We have only have two questions for this Q&A session. So for the attendees, if you have any more questions, want to know about crude oil or even anything about this product, you can contact the branch or your advisor, your dealer privately after these sessions. So once again, thank you, Mr. David, for the very valuable sharing sessions today. So
Thank you.
before we actually end the sharings today, let me have a small conclusions for today webinar. So after for the attendees, after you have enjoyed the sharing sessions from Mr. David, if you're interested to explore or start to involve your trading investment in this crude oil product in this crude oil market, uh, but if you will never have a futures account yet, you are welcome to contact us. So this is a QR code for you to scan to open your account and start involve your trading or investment in the markets. And this is some of our social media page. We have Facebook, YouTube, and Instagram. So we are constantly will be update some market news or company latest promotion campaigns updates in our social media, as well as today webinar recording will be uploaded in a YouTube channel later on. So if you're interested to know more or want to explore more the sessions, the sharings regarding on the market, uh, especially the investment and trading, you're welcome to visit or to search in our social media platforms. So this is all the contact details for all of our branches and our headquarters in Kuala Lumpur. So if you have any questions, you're welcome to contact this number or drop your inquiry to the email. So our staff will be able to assist you very in a very immediate time frame. So I think we are coming to the end of our today webinar sharing. I would like to very thank you to our Mr. David Low to spend a very precious time to share their thoughts over this crude oil market. So if you have any questions, you can drop your questions in the chat box for one last time. And thank you for today. And we see you at the next webinar sharing sessions. Thank you.